Thank you very much. I'm so glad to be here, and hello from the other side of the planet. I understand you guys are joining mostly on a Friday evening. I wanted to tell you thank you for coming at such an inopportune time. So the presentation I'm going to give you has been created particularly for folks in the oil and gas industry here in the U.S. I'd love to hear at the end of the presentation more about what you guys see on the other side of the planet. But the picture I'm going to paint is one I've been building slowly over time. The pieces really fell in place last year, but also the transitions that I see are all accelerating. It's just continuous news. Now, I see two big issues going on. The first is climate change, climate awareness, and action taken by businesses, at least as much as governments, to address that issue. But COVID seemed to accelerate that issue and seemed to accelerate us towards peak oil demand. Now, when it comes then to what we're going to do about it, then I apologize. I'm going to make this work. There we go. When it comes to what to do about it, there's probably a different set of answers for the people in the industry here in the U.S. than in other parts of the world. So I'm going to edit this presentation a little bit as we go along. So what we know from COVID that it's already done was really straightforward. We had a massive drop in use of oil. At its worst, we lost about 30% of demand. And we're still running about 8 or 10% below previous demand, which means we have, even considering offset declines, something like 6% of global oil supply is shut in now and available to come back online at a minute's notice. The other major thing it did that's not controversial, not interpretive, is that the process of shutting down demand that happened faster than shutting down supply. And so we created a massive inventory that's also available for immediate production and delivery for when demand begins to return. Now, in the near future, there are people who think that demand will return to its previous level around 2023, but many people don't, and I'm one of those people. These slides I'm going to show you are a little bit dense, but in the lower right corner of each slide are my citations, and you're welcome to have a copy of the presentation to do some more research yourself. Now, this graph is a proxy for what oil and gas demand did, but here's what I want to point out. The IHS service believes that we'll have a permanent loss of 3 million barrels of oil a day. We'll come back to that because I think that makes most sense. Now, historically, oil demand growth has depended strongly on economic growth, so that when the world is growing more quickly, the economy is doing better, oil demand grows more quickly. And bearing in mind, I'll show you a slide in a minute, oil demand has been on a continuous upward trajectory. When we talk about a supply glut or a supply shortage, it's not against the constant baseline, it's against a growth profile. Best as we can tell, the countries hit harder by COVID will suffer worse economic impacts. That is to say, the countries that are sicker, they don't protect as well. The people's health also do not protect as well the economy. This is the best analysis I've found. It's rather inconclusive, but does show good evidence that based on the 1918 flu epidemic in the U.S., that the countries who take a stronger, more robust set of measures to protect against the disease also have better economic outcomes. And you can see that today in China and New Zealand, which are already practically back to baseline. Some of the largest economies in the world, like the US and in parts of Europe, can be expected to have reduced economic growth for a number of years. But aside from that, there are a number of issues that weigh against having a shortage that would drive prices up. This is a graph showing where surface inventories were pre-COVID. So we were running around 3.3 billion barrels of oil. We have maybe 35-ish days of supply of oil in storage, in tankers, and in surface tanks. But this is what happened in COVID. We shoved and still have nearly 1 billion barrels of extra oil in surface tanks available to be used. Now add on top of that the fact that before COVID, pre-OPEC spare capacity, unused capacity, was at a multi-year high at about 3 million barrels a day. OPEC unplanned outages were also at a multi-year high, about 3.8 million barrels of oil per day. And we add the fact that there were a ton of drilled wells uncompleted in the US, which provide an inventory to complete at relatively low point forward costs to prop up the supply from the US. So all that to say, the situation right now as a result of COVID is that we have demand running about 8 million barrels a day less than it used to be. And we have 6 million barrels a day of capacity shut in for COVID. We have 1 billion barrels in storage. We had 3.8 million barrels. All that is a ton of oil that can come back on. Now let's put that in context of supply and demand. Remember I said over history, supply and demand have always been going up. So if we have a shortage, then it means that demand grew faster than supply. There's a little bit of a gap. And that gets handled, buffered through inventory and other forms of spare capacity. And a supply glut or a supply shortage has historically meant anywhere between 500,000 and 1.5 million barrels of oil per day, excess or shortage, which is not very different. Now, you can see it's been constantly going up. It's been going up constantly by about 1 million barrels of oil per day. That is, each year we need to produce about 1 million barrel of oil per day more than we did the year before. On a percentage basis, it's slowing down. It used to be that 1 million barrels of oil per day was 2 or 3%. In recent years, 1 million barrels of oil per day is about 1%. And the most recent growth rate was about 0.8% per year demand growth. So we've already been slowing down our growth on a percentage basis. Now add on top of that the fact that the natural decline of existing production is on the order of 5 to 6% per year. And what that combined, what that means is every year the oil industry on a global basis has to create new supply equal to about 7% of the total demand. The thing is, that aspect, the exploration and development of new production, is going to change substantially when we hit the inflection point of peak oil demand. Now, to be clear, The developed world has already gone through peak oil demand. This is the 35 developed countries of the world. This is their oil demand graph, and you can see that it peaked about 15 years ago. It has had some increase here in recent years. It seems to be a function of the shale revolution in the U.S. But the peak oil demand is not a peak. It's not like the Matterhorn in Switzerland where it's a sharp point that turns a corner. It's more of a gentle roll over. But so what's happened is demand has continued to grow here. Is the developed world's demand has declined as a function of efficiency, and the undeveloped world, particularly China and India, have increased their demand, so it's a net positive. So if you want to understand what the future of oil demand looks like, the thing is to watch the policy and the behavior in China and India in particular. Also, how fast the developed world, especially the US and Europe, change their behaviors to increase efficiency and reduce their demand. So there, in the US, people often talk about how there's a lot of unmet energy demand in the world, and that's true. But meeting the energy demands of Africa and South America are not likely to occur before we complete this energy transition. So what I see from where I sit here is that China and India both are taking increasing steps to reduce oil demand, both in terms of plastics and in terms of fuels, and then we can expect that to continue. But that's rather qualitative. I prefer instead to look at published reports by independent parties about what they see. Always a good place to start an analysis is to see what have other people found when they did their analyses. And these are the primary large-scale analyses supplied or delivered to the public for free. Major organizations that conduct major studies and publish them each year. A bunch of these came out last fall. Interestingly, ExxonMobil, for the first time in my career, did not publish their outlook for energy. If you want to look at something on a faster time cycle, you can look at these reports that come out of these organizations every month. But what all of these do is use a method called econometric modeling. And this is essentially a simulation of supply and demand. It requires a bunch of inputs that are not scientific. They're not science-based, can't measure them in a lab. They're hard to quantify because they're all indirect. But they put those into a supply and demand model to forecast what's going to happen in the future. The problem is that these econometric models have a terrible track record. This graph shows on the left the EIA's forecast of oil demand in the US, and on the right, the IEA's forecast of oil demand in the OECD. And you can see that at the point when demand was actually peaking, the simulation models, the econometric models they forecasted decades of growth. That is, they missed peak oil demand hugely. Even when peak oil demand was on top of them, they didn't see it. So when I read these reports, I don't read so much to understand what their forecast is. My question is, how has it changed from one year to the next? And what I see is that everyone's forecasts of oil demand have been continuing to decline. Now, BP in August, or September rather, took the most extreme position, and they said oil demand has peaked, or we are on top of that plateau right now. And the only question is, how fast are we going to decline? I think there's at least a 50-50 chance that they're right. But if you read the rest of these reports, you'll see that they all showed movement in the date of peak oil demand forward. They all brought forward in time, again, their estimate of peak oil demand. And what's more, when in all of them that looked at continued change to policy, they thought that we would see peak oil demand by 2030. Now, my personal bet, a personal opinion before COVID was peak oil demand would be 2027 plus or minus 5 years. Now, I think it's 50-50 that we've hit peak oil demand right now. And that because we have tremendous excess capacity, because there's acceleration in offsets, acceleration in efforts to reduce the amount of oil that we produce, but also because I believe that COVID will have some change in our behaviors that cause oil demand to cause the suppression of oil demand. About 55%, maybe 60% of all of the oil that we produce goes into transportation fuels, airplanes, automobiles in particular. If there's even a small change in the amount of business travel on the airplanes, maybe 1% change, or a 1% change in the number of people who drive to work, or the amount of driving people do to work in the US, then that would offset a year or more of demand growth. And what I believe is that we are seeing a change. People have accepted the change in behavior, and that will cause there to be demand. Demand won't come all the way back to where it was. Like I just said, they expect 3 million barrels a day to be permanently lost. I think that's a fair estimate. So you take the excess capacity, the structural reduction in demand by recession and by change in behavior, and you have a sustainable long-term imbalance where supply is greater than demand. And that kind of dynamic has not been baked in to these forecasts by the IEA, the EIA, and others. When that does get baked in, I think we'll see it shift down. But there's one other dynamic on global oil demand that could swamp all of these. First, let me rewind and say that what I'm talking about is oil demand, not natural gas. Oil and natural gas are different commodities with different supply chains, different end uses. They do not correlate well at all. And I do believe that natural gas has more legs, has the ability to sustain and produce longer. But here's the secondary issue. It's the behavior of OPEC. This graph shows the reserves, and I've granted all of these have problems, but directionally it's correct. These are the reserves or resources of Saudi Arabia, the Kingdom of Saudi Arabia, Russia, and the US. These three are the titans, the three largest producers of oil today. Saudi Arabia has by far the largest. Soviet Union's, or the CIS is not even that anymore. Russia is substantially more than the US. But the Saudis have more than just reserves. They have the lowest finding and development cost by far. They have the lowest operating cost. They have the lowest carbon intensity, and we are beginning to see not just investors but buyers of oil and gas be conscientious of the sustainability of the producers. But they also have, so that is to say, they have a structural advantage in every way. The other side of it is they have a centrally controlled economy that has had nothing else besides oil and gas. And they have been managing for decades their national wealth on a centuries time frame. So when I've said for years that when oil demand peaked, it was approaching a peak, what made the most sense for them from a business standpoint is to create a large scale bust, to set prices at a level where most of the world can't, not most of the world, but where large portions of the world can't make money, so that the market is cleared of high cost producers who are hanging on and producing stuff that doesn't make economic sense. This gives the OPEC and the Kingdom of Saudi Arabia better control of the market. That also has to their benefit to drive out a lot of producers, so that there are fewer companies to respond to supply and demand issues. And when that happens, then they have, one, the ability to sell their oil, and two, the ability to manage the market more easily. Also, of course, if they set prices low, that is a stimulus to demand, and it can delay or elongate oil demand. So my theory has been that they would orchestrate a glut that would keep prices low and sustained. So that's my paradigm when I'm looking at this year's events. And they fit, although not perfectly. Here's what I observed. First, the Saudis triggered a price war. Now, the price war was meant to sustain prices because they didn't want this oversupply to be atrocious, worse than it was. But what was most interesting to me about that was that the Saudis picked a fight that they probably couldn't win in the long term. But they were very aggressive to punish the lack of consensus. They were willing to inflict harm to themselves in order to control and manage the market and the cohesion, their leadership in that cohesive group. Second, Saudi Aramco affirmed in August that they would add 1 million barrels a day of spare capacity. They already had 2 million barrels of oil a day spare capacity. In a world that has 6 million barrels a day of spare capacity, in a world that has tremendous volumes that were already shut in, tremendous ducts, tremendous inventory, they still were wanting to add excess capacity. And indeed, they only dropped their rig count initially by about a quarter, where most of the world dropped about 50%. Now, they have dropped their rig count more now. The common rebuttal is, well, Saudi Arabia has to have much higher oil prices to maintain their government and their incentives, their benefits to the population. And that is historically true. But since 2015, they've been revising their plan and their budgets. And for 2021, the budget of Saudi Arabia relied on an oil price of 50 or low 50s for Brent. So one other point of information for the January meeting of OPEC, Saudi Arabia did say that they were willing to unilaterally cut additional oil in order to maintain prices, which is a break from tradition, a break from recent history. What I take from that is that Saudi Arabia wants to keep oil prices around $50, low 50s Brent, and they're going to take real steps to make that happen on both the high side and the low side. They want to leave it there for a while. So there's this other changing dynamic that that's part of the reason that we've seen the continued decrease in the forecast of econometric models, and that's the issue of climate change. I know in the U.S. It's reasonably well accepted, although not in public discourse. There's a weird disconnect. I have no idea how it's accepted and understood there on those and other places. So I'm going to skip a bunch of this dialogue that's all about how it's real. But as an aside, it's interesting to note that Americans believe that about 55% of other Americans believe in the climate change thesis, when in fact the actual number is around 70%. This shows the trend in belief by Americans in the scientific consensus. It's only been going up. My thought is that will continue. It will only continue to go up, but that COVID and 2020 as a whole could accelerate that. Interestingly, 4 in 10 Americans believe they have already been affected by climate change. And what 2020's events were pretty dramatic and may affect the attitudes here. So there were 22 natural disasters in 2020 in the US with over $1 billion worth of damage. And there were other specific events around the world, dramatic events. This is actually from 2019, but it shows a sled team mushing across the ice pack, or the former ice pack in Greenland. And we had the wildfires in Australia. We hit 100 degrees Fahrenheit in the Arctic Circle, and that happened 2 weeks before we hit 100 degrees here in Texas. That heat in the Arctic Circle is creating methane craters like this one that have been dramatic in the news. This crater is the largest one. It's 165 feet deep of earth that was blown out the top by methane released from heat. There were wildfires in California that put ash all the way over to the other side of the continent. There were, of course, wildfires in another state that put a bunch of people at risk. Maybe most dramatic was our hurricane season. It tied for the most, it had the earliest, it had tied for the most at the same time. And every bit of the US Atlantic coastline was hit by a hurricane, with the exception of a little bit of area right here. But otherwise, from Maine to Brownsville, all the way through here, every part was hit by a hurricane. So, and of course, this new president we have has taken climate change very seriously. So maybe the public is catching up, but the rest of the world is already there. And what we're seeing is increased pressure from financial, in the business world, in the financial world, on our oil and gas companies. The first action, organized action that I know of, was this Climate Action 100 in December of 2017. But you can see that over the first 9 months of 2019, or 2020 rather, that grew by a third. It's growing very rapidly. What happened this year for the first time is that investment companies are publicly declaring that they will not invest in oil and gas producers. Started in January, but it's accelerated very rapidly. Here are some of the examples. We have trillions and trillions of dollars who refuse to invest in oil and gas. And that's the reason why I think, or part of the reason why ExxonMobil was removed from the largest stock index in the US, Dow Jones Industrial Average. It had been there for nearly 90 years. It was the oldest member of the Dow Jones Industrial Average, and it's gone, which blows my mind. But we're seeing similar sorts of pressure from other organizations as well. Development banks are no longer funding oil and gas projects in many cases. Major lenders are under pressure, most significantly, as an example, JP Morgan Chase, which is the world's largest lender to fossil fuels, made 2 statements, one in February and another in August, of increasingly tight standards for lending to oil and gas based on emissions. And I'll tell you that there are insurers already under pressure who are refusing to insure the worst of the carbon offenders, coal, Arctic drilling, and tar sands. That has been growing exponentially, and it will continue to grow. This business pressure is only growing. Now, the next part of my speech is again aimed at an American audience, and that is to say climate change. The reason that public opinion is growing and the reason that business opinion and action are growing is because the science of climate change is settled. There are classic tobacco strategies employed to confuse the issue, but the opinion of the scientific world, the people who have been studying this for their entire careers, the PhDs over hundreds of universities, is consensus that there is a climate emergency. And the way that they've come to this opinion is really robust. It's been evolving for decades, and they've got built in multiple layers of security, of confidence, of quality control to make sure that the outcomes are reliable. And the most recent reports say that, and even as far as 6 and 7 years ago, all say that all of the major conclusions of climate change are between 90 and 100% certain, or between 90 and 99% certain. So by analogy to the oil and gas industry, climate change is proved, developed, producing. It's online, it's happening right now. We can project a trend for it. It's high confidence, you can bank it. Now, there is another major structural issue that we face. And I don't even have time to really go into this, but the point is that renewable technologies have become heads up competitive with oil and gas for the production of electricity. And again, I don't know the prevailing opinion where you are, but where I am, this is a laughable idea. But I'll tell you, there are plenty of studies here and articles you can read that will show you that they have become cost competitive on a heads-up basis. In 2019, there was as much new electrical capacity on a global basis added from renewables as there was from fossil fuels. And that trend will continue because solar and wind in particular are both on exponential decline curves for their costs. That is to say, the cost has been declining on an exponential basis for a couple of decades. And it won't be indefinite. It won't continue to decline forever, but we do not know when it will end. And that increasing cost efficiency will, on a purely economic basis, also eat into our industry. So then the question is what to do. And in the US, we have a lot fewer options than we have elsewhere in the world. So these are all the pieces that go directly into a cash flow, go directly into making money. The thing that's most important to know about our industry is that the industry in the US is extremely mature. Our geology and our producing wells, our geology for exploration and our producing wells are both extremely mature, which is to say the large portions of the US will be part of that purge of the industry that I believe Saudi Arabia is trying to organize. Let's look first at volumes. So remember the three kingpins are Saudi, Russia, and US. This graph shows the production from Russia and Saudi over about the last 70 years. Now, they both had these time periods of political issues that caused a reduction. But on the whole, they have a continuously increasing production. And what's most astonishing to me in the US is that Saudi Arabia has been able to accomplish this growth using about 100 rigs, where in the US we peaked at about 2,000 rigs. Now watch this data point here, this location here, and because that's my frame of reference to compare to the US. Now, what I've done here is to break down US production into three components. If you look at the grand total, it spikes, it comes down, flattens, dips, spikes. But what we have, in fact, are three Hubert curves. We actually have more than that, but three large-scale Hubert curves that are pretty easy to identify. So this first green one is what people have called conventional reservoirs. There's no, in the US, conventional now is shale. Not by practice, more than by nomenclature. It took us 103 years to get to this peak in 1970, but that was 50 years ago. We're 50 years past peak in our conventional oil production. Now, Alaska had a peak a little bit later. It's on its way down. This is the shale peak. Of course, I have extrapolated production using a forecast by shale profile. But bear in mind that this is 10 years. Now, the grid lines are a decade. So we are very, very mature. We have played out, we have fished out most of the geology. Now, there are still some plays that are ongoing. I'm not saying that. But the opportunities are much less than they were. Now, this graph shows the number of wells brought online, number of producers brought online each year since 1970, since peak oil demand. And what's interesting, well, the yellow is horizontal and the blues are vertical. So it's a proxy for shale, for horizontal and conventional. There are some variations like this correlated to price, but mostly these major changes correlate to major international events. We have the oil embargo, the Iranian Revolution, the OPEC war, and then so step up, step up, step up, and then price war, and then COVID is here. All that, on the whole, you can see this decline in conventional production. You can also see a decline in shale drilling. Although that line is not exactly extrapolation, more of a connect the dots. Back in this time period, the companies were drilling in almost all of the basins in the U.S., but it diminished over time. And it's not that we have zero basins; it's zero basins unaffected. But today, drilling is insignificant outside of just 2 or 3 basins in the U.S. All the other basins have not merited exploration and drilling for a number of years. Now, the Permian Basin is doing, it's continuing to grow. It's a concentration, but many others aren't. On the other hand, we are shutting in our wells rapidly. This graph shows the same events in red, and the bars show the number of wells shut in each year. That is the number of wells whose last production is that year. We had been running on the order of 15,000 wells per year, but it has spiked now up to about 45,000 wells per year. And at the same time, the economic limit at the rate at which the wells are shut in has been turning up in recent years. That trend is going to continue. Now, the wells that we have that are online are really old. On average, they're 34 years. It's a bimodal distribution, but you've got the majority of wells that are 25 years old or older. So we have very old, decades old wells. What this means is if you want to explore, you're looking at very mature geology, hard to find things to drill, hard to find things to drill economically. And if you want to buy producing wells, you're going to be buying predominantly old, low-rate producers. If you want to stay focused on shale, that is also beginning to play out. Now, these next 2 graphs I'm going to skip over quickly. The bottom line is that we for many years, high graded, starting in 2015, with that price crash, we high graded our acreage. We drilled better and better areas in order to produce well enough to make money. We have now begun to downgrade, that is, go back out to drilling lower quality rock. And the experimentation we did over the last 5 and 6 years to try to increase our production, mostly increase, for most plays, increase initial rate, but did not increase reserves the same amount. They started at higher rates and then they declined more steeply. So we can't expect technology or geology to save the shale revolution. It has begun its decline. I haven't seen any forecasts from anyone that says that shale production in the US will attain or exceed its previous peak. We've already lost 2 million barrels a day of rate by natural decline because the rates are extremely fast declines. And from here, the question is just how fast it goes down. So there are some other strategies that oil and gas companies could begin to use. We could focus on carbon capture and storage, CO2 floods. We could go international. But the options are relatively limited. We can't rely on better geology. We can't rely on technology. We can take a strategy of PDP as long as we're willing to handle asset retirement plugging obligations. There are some plays, Middle Darcy reservoirs, that are economic, but they're hard to understand. They're relatively few. My personal guess is that the industry in the US will pivot towards natural gas here in 21, 22, in the way that in the past we've pivoted from oil to gas and gas to oil. I think we're about to pivot back from oil to gas. With prices, we can't do much. We ought to use hedges better, and maybe we can choose our basins better so that we have better netback prices. But we can't reduce our costs the same way we did. We took out so much of the profit from our service companies 5 years ago. We have this new issue that we really have to wrestle with asset retirement obligations to increase our costs. So what people are doing is focusing on digital technology and on reducing headcount, and you'll see those sort of universally. This graph, this table rather, shows different strategies that oil companies are using around the world, sort of a combination of the others. Interesting point of reference. The thing that really surprised me, though, this was very telling, was that the 3 largest service companies are all taking major steps to restructure their business by leaving North America, focusing on digital technology, and diversifying out of oil and gas. Huge structural change by all 3 of the largest service companies. So this map at the top shows all the global locations of offices for Halliburton before 2020, when they shut down 100 North American facilities. Schlumberger shut down 150 North American facilities, and they sold their pressure pumping. All of them are trying to diversify outside oil and gas. So I do believe so that's pretty dramatic evidence to me about the lack of optimism about the industry and about North America in particular. And so the position that we sit in now, if I were playing blackjack, does not look like this. This is a great hand in blackjack, and there was a time in my industry when I felt like I was holding a pair of 10s. But right now, the hand is not nearly as generous. So there's an idiom in Texas about having a Texas hedge. A Texas hedge is when you double down, you concentrate risk based on sort of a cowboy philosophy. But my point is that at this point, it's no time for a Texas hedge. Instead, what people should be in the industry should be doing is diversifying their opportunities. They should be creating the ability to leave the industry. The industry is going to shift and change. The people who are involved in operations, they're going to be around the longest. But when we go through peak oil demand, those of us involved in finding and creating new supply, the geophysicists, reservoir engineers, landmen, exploration geologists, large groups of people will no longer be necessary. And the folks, drilling engineers, the folks who conduct the operations to keep the wells running, they'll have a longer career in front of them. In fact, the strategy that works the best going forward in the US especially is all about reducing operating costs. And internationally, that's another story, because the most new production that is necessary will come from abroad, but there's still the industry will require many fewer than half as many of the exploration side of the business as we had before. So I'll tell you what I really want is just one more boom. I've heard this bumper sticker has been around for nearly 40 years. And I would love to have one more boom, but my second best is to try to handle this situation as best as can. And one of those things that we can do is to share, to cooperate, collaborate, not to see other oil companies as our enemies or our competitors, but instead see them as allies, where we can share strategies and information to reduce costs and to remain viable as long as we can. So thank you. I appreciate you being here and listening. I'd love to take questions. You can type them into chat. You can speak up if it's okay with the moderators, or feel free to reach out to me directly. My website is here. Whoops. My website is here, and you'll be able to find me just fine. So I'm going to turn on the chat now and say thank you again.
Okay, thank you so much for this wonderful session. And thank you everyone for your valuable time and cooperation to make the event successful. So I, on behalf of Team PA, thanking Purvis sir and providing us time for busy schedule, and hope you have all and participants us put in WhatsApp group, and the sir will happy to answer questions. So thank you, sir. Thank you so much for this wonderful session, and we'll conduct some more sessions like this in the future. And thank you everyone for joining this session. Thank you, sir. Thank you so much.
Very good. Thanks so much, guys. Have a good weekend.
Yeah, thank you, sir. Thank you so much. Thank you. All right.